Fresh data on the leading indicator says the consumer is collapsing and, quote, near zero growth is coming. The new data comes from the Conference Board, which is one of the most prestigious economic prediction outfits going back to 1916, when lying government statistics were but a twinkle in the eye of the bespectacled totalitarian Woodrow Wilson. The Conference Board's most important work is precisely this index of leading indicators, which has been estimating recessions for 110 years. And in those 110 years, its track record has been pretty decent, certainly better than our taxpayer-funded versions. Since the mid-'80s, for example, it's flagged all 4 recessions with just 2 false positives. Those were 1986 and 2016. Of course, both were near recessions. In 1986, we got Black Monday, the worst stock market crash since 1929. And in 2016, we had the stagnant Obama economy, which was precisely what handed the White House to Donald Trump. So what are the numbers saying now? The latest figures for February showed consumer confidence plunging 3.8% on the month, which is a big drop, along with the biggest downward revision in series history. In other words, however we thought consumers were feeling, it is a lot worse. Other drops included shorter work weeks, which is a pretty reliable indicator that layoffs are coming, falling manufacturing orders, falling building permits, falling consumer expectations, and a deterioration in the interest rate spread, all of which are reliable recession indicators. To be fair, there were a couple bright spots. Stock prices, which it's worth mentioning, always go up early in inflation. So in Germany's Weimar hyperinflation, they were actually celebrating because stocks went to $1 trillion before eggs went to $1 trillion. And also in credit, since there's still trillions sloshing around Wall Street for big companies to borrow, even though regular suckers are paying 8% on a car loan and 22% on the credit card. Beyond the dismal print, the bigger problem is that leading indicators is currently running negative for the 22nd month in a row, which is the 3rd longest losing streak in a century. The last time it was this bad for this long was the 2008 financial crisis. Before then, it was the lost decade of the 1970s stagflationary crisis. What's driving it naturally is sky-high interest rates that are failing to end sky-high inflation, along with out-of-control government spending, which shows up as GDP but is not going into American consumers' pockets. After all, spending $1 trillion per year on migrants is money wasted, doesn't actually go to American consumers. Meanwhile, what we give to Ukraine is blown up, while money spent on, say, climate mandates or EPA regulators are predators on the real economy. We're essentially spending money to make ourselves poorer. So what's next? Brought to you by Unchained.com. While 22 down months is dire, it's worth noting the Conference Board is only predicting, quote, near zero growth for 24, not outright recession as defined by GDP. And that's because of the reasons above, government spending. Of course, that becomes a statistical mirage if consumers are getting poorer even as GDP booms. Toss in inflation that's rising again, and it saps what little growth we have, and even that near zero becomes very fragile. And so, after a surprising 2023, indicators are back to debating whether we are stagnant or shrinking. The likely tiebreaker will be inflation. If it keeps up, we could be looking at a long 1970s-style stagflation, this time with a 2008-style worldwide financial crisis that, if it snowballs, could knock us back to somewhere we haven't seen since the 1930s. Okay, we'll be watching. See you next time.